inventory impairments, lower of cost of market versus lower cost of net realizable value. So overall, the big idea, whether we're dealing with LCM or LCNRV, which is a pretty common acronym for the two types of methods, what our idea is, what we're trying to accomplish. When the market value or the NRV of an asset drops below its original cost, and I say of the asset, but really we're talking about of the inventory, because these terms are being used in the context of inventory. When it drops below the cost, and the cost of inventory, remember, is either the cost we incurred to make it, the manufacturing cost, or the cost that we incurred to buy it. We abandon historical cost and create an adjusting entry. So this happens when the market value is less than the cost. Only when that happens. So I want to note that, cost is where the inventory ledger account, what that dollar value is. So when we refer to cost, we're referring to the ending balance of the inventory account. Notice that it's an adjusting entry, which means, I hope we know at this point, it's an entry that's made at the end of the period. And so in order to determine if this entry needs to be made and for how much, that we're analyzing an ending balance, because we're at the end of the period, we're making adjusting entries. So the loss that is recognized when this happens, and only when this happens, right, is usually termed either a loss on inventory write-down, or more succinctly, inventory impairment. And it's classified as an operating expense on a multi-step income statement. And that's something that, I hadn't really emphasized in the previous chapter, but it is something that you really do want to be keenly aware of, because now that we've really tackled the multi-step income statement and understand that, certain expenses go into operating expenses, cost of goods sold is an operating expense, but it's disclosed separately from operating expenses. Then we have some that are in other income, and then, different places to put these things. You should start thinking about where these things are placed. Bad debt expense is an operating expense. Sales returns reduces sales revenue. So it's not even in the expense category. It just reduces my revenues because it's a contra revenue. Sales discounts, same story as sales returns. And so you need to keep putting these things back into that foundational aspect of what we've talked about already. Because, when you get into intermediate 2, there's just going to be an assumption that you're growing this list and you kind of know what's on the balance sheet and what should appear there versus what should appear on the income statement. So if it's the case that cost is greater than market or net realizable value, then we should revalue the inventory at market, and we should report a loss in the period of decline. So we want to report the loss. Basically, we're reporting the loss in advance of selling it. And that will be important. I'll kind of roll through, kind of an example of that down here. You're recognizing the loss of utility in the year which it occurs, not which it's sold. We're following conservatism. If market value is greater than a cost, we do not increase the value of inventory. So if cost is less than what we're going to sell it for, or what we think we're going to realize when we sell it, no impairment is needed. It's already at the lower of cost, because it's at cost already, right, or market. And that again goes back to understanding that whatever the inventory is at, the ledger account, the imbalance of that account, that's the cost. So if it's already lower, there's no impairment entry that is necessary. And you know, in this moment, recall when we talked about discontinued operations, we talked about impairing discontinued operations, and we only did that when the book value of net assets was greater than the fair value of net assets, i.e. what we think we can sell it for, minus cost to sell. And this is what I mean about accounting being the same set of guiding ideas, just applied sometimes with small variation to different categories of items. Because here we're talking about the cost of inventory. Well, really the cost is just the book value of inventory. It's where the inventory account is at the end of the period. And if it is already an understatement, then we're good. But if the amount that we have in the inventory end balance is more than what we think we're going to get when we sell it, then we have to apply some sort of a write down. We have to make an adjustment. All right, so let's look at, you know, what happens if I don't do this. So basically I have this example. The inventory ending balance is $100 at the end of the period. After assessment, the market or NRV, whichever one we're doing, and we'll talk about the difference between the two in a second, is 90. So I know that my cost is greater than my NRV / market, which means I got to write it down. Because right now, my asset is overstated compared to what I could eventually sell it for. So if I apply the LCM or LCNRV on 1231X2, then one common way that's done is by debiting cost of goods sold, crediting inventory for the amount of the write down. The amount of the write down, right? I just need to get 100. Instead of being 100, I need it to be 90. So it's going to be a $10 amount. And one method to do that is to put it in cost of goods sold. So we'll just drop it there. And that seems kind of weird, right? Remember, I haven't sold it, but its value, its future, its utility as a product has been reduced. I can't sell it for 100. I'm going to have to sell it for less than 100. So I'm recognizing some amount of expense in the period that I recognize this is going to happen. And again, this is happening on 1231X2 because it's an adjusting entry. It's at the end of the year. So then subsequently, I'll make a sale, right? And let's say I sell it for 120 in January of the next year, X3. Well, when I sell it for that amount, of course, I'll either have cash or maybe it's a credit sale, whichever one it's sold for, $120. I'll recognize that sales revenue, and that'll be $120. Then I have my cost of goods sold. My cost of goods sold is no longer 100, right? I credited the inventory account, which was at 100 by $10. That drops it down to $90. So my cost of goods sold is $90, and the credit to inventory would be $90. Now let's suppose that's applying LCM. Now let's suppose that we didn't apply LCM. So if we don't, there's no application. That means we have no adjusting entry. We don't reduce the value of the inventory. And then we have a subsequent sell for $120. Right? Well, then at that point, I'll have the same here, cash or accounts receivable for $120. I'll have sales revenue for $120. But the cost of goods sold is now still at $100 because I never wrote it down. Well, let's look at, was there an overall effect to apply an LCM, to not apply an LCM? I have $120 of sales revenue, and I'm going to recognize, so I have revenues of 120 overall, and I have cost of goods sold of 100 overall. And so I get $20 of gross profit. Over here, I have $120 of revenues, and I have $10 of cost of goods sold that happened in a prior period, and I have $90 of cost of goods sold in the current period. But we'll look at them as if, you know, we're looking at the revenue between two periods together, still gross profit of $20. Now, it's the same result. So why enact the LCM, LCNRV principle? You know, to get it at this value. Why are we concerned about it? Well, first is, well, the overall is conservatism. And conservatism tells me that it has a few consequences. You know, that it's overly simplified to say that, well, when I have two options that are equally desirable, I choose the one that understates net income and understates assets. Conservatism also means that the financial reporting system will recognize losses more timely than gains. Oops, than gains. So I'm more likely to recognize a loss ahead of time. I never recognize gains ahead of time. It's also more likely to just recognize losses than it is to recognize gains. Sometimes we have the exact same situation, and if it's a gain, we don't report it, and if it's a loss, we will report it. Right? So conservatism plays a huge role in this, and this is the exact same thing that we studied with impairment. I could just not impair my discontinued operations, and I will get the same overall effect over 2 years in terms of the effect on net income, or the overall profit that I'm recognizing. But really, there's an emphasis on the timing of the recognition. Remember that all of the things we're doing with accrual accounting don't affect whether expenses or revenues will be recognized. They only affect when they're going to be recognized. And that is definitely a huge, huge consequence to the markets, to equity markets, to investors trading on information, to being able to predict the income and the cash flows and the accrual income of a company over time. So it is important, even though it doesn't have an economic impact on profit. Timing is everything. Why would value decline? Maybe obsolescence, right? The new version of the iPhone came out, so the old version, you know, they can't charge. I don't even know what an iPhone they're on right now. I unfortunately still have an iPhone 8. Not unfortunately, I really don't use it that much in order to get the latest and greatest. I think they're on 12. But anyway, you know, like when 13 comes out, 12 will drop in price. Physical deterioration, maybe the inventory has been sitting there so long that no one really wants to buy it. glut in the supply. So there's so much of it that the market price drops, right? We have more supply than demand, prices drop. Changes in consumer tastes. Garmin was the greatest GPS until Apple had an iPhone that had GPS on it. And it was like, who cares about Garmin anymore? So all these reasons, inventory value can decline. And again, it's an adjusting entry. And also to understand just where it fits with the other adjusting entry, the LIFO reserve adjustment, it is recorded at the end of the period and after the LIFO reserve has been carried out. And the reason is that you need inventory at LIFO since you're reporting the balance sheet in LIFO before so that your cost in the lower of cost or so that your cost value is LIFO. Remember that this is very important because LIFO assumes that the oldest purchases are ending inventory. If my oldest purchases are my ending inventory, that means in times of rising prices, they're going to be my cheapest in terms of inventory cost. And if they're my cheapest, that will affect the cost that I'm comparing. Remember that one of the advantages that I said LIFO has is that it's less likely you're going to write down the inventory in a lower of cost or market analysis. All right. So let's talk about when we do LCM versus LCNRV.